Hi guys, once again this is Alfred from BinaryOptionsTutor.com. In this video I'm going to be talking about how to get the biggest bang out of the tweets that I'm doing pretty regularly here on Twitter. To get started, I want to point out the time and the place. You can find me on Twitter at Trader Alfred. Binary Options Tutor is going to look like this feed right here. And the time, I'm usually tweeting overnights. Right now, I do a lot of tweets and commentary with marked up charts about the S&P futures. So I'm usually between 2 and 4 a.m. for my overnights prior to the market opening. Sometimes it's earlier. Also, I'll come back after the market's closed and I'll usually do some further commentary on what we saw, how it relates to what we were looking for earlier in the day. Okay, now let's talk about chart composition. On my charts, you're going to see 4 deviation levels. All the actual levels that are whole numbers will be denoted with solid straight lines. The levels that are in between are going to be denoted with these broken lines. These are not based on implied volatility. These are our own formula based on historical volatility. Uh, let's see what else. We want to talk about the probabilities. Okay, I say this all the time. If you've been watching my channel on YouTube, statistics are not gospel, but I'm going to give a tip on what I think is the best use of this probability, these numbers over here. These are probabilities based on the last 50 days of trading. Here's what I like to use them for. Right here, we see there's 1/2 deviation, and we've got 42% probability. Above that, we've got 18% probability. And above that, we've got 6% probability. Okay? You see how there's getting to be a big hole in between 42 and 18? That, I can use that sometimes rather than trying to pick that perfect place where the market's going to stop, which is, kind of a fool's errand, even with good tools. It's way easier to know, hey, statistically, somewhere in here between the 14 and 18, there's a lot more resistance right there because that pocket, that hole is really big statistically in between 42 and 6, somewhere in there. That's an even better number because that hole is really big statistically. Okay, so I'll use that sometimes that way rather than just trying to use the stats like gospel. Conversely, look here. There's 48, 42, 36. You see how these numbers are all closer together? 36, 32, 30. This tells me that when the market started moving, like right here, there was a high probability because there's not much of a gap in the numbers anymore that the market could continue moving and that the market could continue moving still because there's not a lot of gaps being painted here statistically. Over 50 days, that's where the money is. That's where the guys who are running the market, controlling about 80, 83 to 87% of the transactions that are going on. And at the end of the day, they're going to get what they want most likely. Now let's talk about my little simple moving averages. If you want to put these on your chart, I just used them like this. This is a red um, 30, I'm sorry, red 42 moving average, and this is a blue 9. Both of these are just simple moving averages on an hourly chart. Anyone can use them. It's in every charting software. I use them for a quick glance to give me a quick bias If you've been watching my videos on YouTube for a long time, then it's the same thing. 3, 4 years ago, same thing. I might change the frequencies, but the concept's the same. Red's on top, downtrend bias. Blues on top, uh, blues on top, uptrend bias. Okay. Now, I've pretty much covered. I think all of the. No, one more thing. Let's talk about these statistical zones. Um, Anywhere inside of this area right here, this is the average swing of the day. Okay, top to bottom. Once you start getting into these zones here, anywhere in here, from here in this light area to midway, that's halfway to the longest swing that we've seen in some time, depending on what I've got these set for. And here, this is the longest swing we've seen up. This would be the longest swing we've seen down. Most days, we're going to probably stay somewhere inside of the average area. But when we start running and you see we're overdoing it, I'll use those to kind of coax myself out of not trying to catch a falling knife. You know what I mean? Um, Understanding the behavior and understanding statistically what are we doing that day. That's about all there is to the composition of the charts that I'm going to be marking up here, that I've been marking up here on Twitter. I'll be back to talk about the next topic. Okay, now I'm going to talk about upside and downside numbers. Usually, well, I'm going to try and always put these on my tweets, and these are just interesting areas to the upside and interesting numbers to the downside. Um, I'm going to point them out with arrows where they are relative to the chart. They're often going to coincide with with pivot points, with value area, with the value area box, and also with some prior points of support and resistance. I'm just pointing out interesting areas. This again is not going to be gospel, but you know there'll be a there are some days when these numbers can be very helpful is to recognizing where corrective areas are in the market, at least on an intraday basis. That's all I got to say about that. Okay, let's talk about my commentary on the VIX. The VIX is sometimes called the fear index. It's a volatility index on the SIBO. I'm going to usually mention the VIX. You can see I'm mentioning here the VIX has the most fear priced in for the last 39 days. Now, I'm going to give you commentary on where the VIX is, and sometimes I'll say things like the VIX is moving down a pinch, or more fears being priced into the market, less fears being priced in the market, and the best way I think to use that information is not just to try and pick a perfect spot on. Okay, well, we're there's an old saying, uh, and the saying goes like. Uh, when the VIX is high, it's time to buy. And when the VIX is low, it's time to go. Now, and that's great. It's cute. It's easy to remember. And I'm showing you this particular tweet here just to make a point. You see how the market ran down? And I was quoting over here. This is August 1st, 2019. Market's running down, and the VIX was the highest it's been in almost 2 Well, yeah, almost 2 months, at least a month and a half. Now, that was produced by all of this action to the downside. Okay, and you can see even professionals, some of the institutional guys coming in, starting to pinch a little bit and actually buying. Okay, now another way to look at it is there's a lot of fear in the market, and so let's go to the next day. Here's the next day. Guys are still pinching in and pinching in. Okay, we're about midday. Some guys are really starting to go ahead and follow this little axiom. VIX is high, time to buy. And then all of a sudden, here at this particular time, Donald Trump comes out with a tweet talking about the trade war. Because there's so much fear and emotion in the market at that time, look at how the market just continued to plummet. So you don't want to always, it may be cool for institutional guys, but if you're a retail guy, you don't want to try and pick tops and bottoms based on the VIX. What I'm getting at is it's easier to just keep up with my tweets and what I'm talking about more on a directional basis. If fear is growing, you don't want to be trying to catch that top or that bottom in this case in buying. If fear is dwindling, you don't want to be trying to catch that perfect top in selling at that high. That's a difficult thing. Can you do it? Sure, sometimes. Uh, will it work more times than not? Mm, probably not. And that's pretty much all that I wanted to share about when I'm commenting about the VIX. Okay, here's another tip, and I like to call this failure foreshadow. What I'm talking about is when you're looking at the deviation levels for the day, sometimes we'll fail to even reach half deviation, and when most of the day is already gone, and we fail to even make it up here. Let's say we failed to even make it to halfway of the positive plus zero point 0.5, then you can sometimes infer from that hey, we're if we were in an uptrend, it's drying up, and there may be foreshadow of the trend reversing and starting down at some point in that day. Now, what I mean by far enough along in the day, I mean at least 16 or 17 of the hours of the day. So there should be about 7 or 8 hours left in the day. And you can see it there, and you can see it here, and you can see it here. Where I've got these highlighted is where we're hitting the half. Now here's the opposite. We failed right there at the half deviation, but this time it's the negative, and we got that bounce here. Failed at the half deviation, and that time it was a positive. We got that push backwards. I think that's all of these done knocked off. Um, I want to also talk about when you see these are hourly candles. A good idea, just in my opinion, I'm not a financial advisor or anything. Okay, good idea is look for three, look maybe for 3 to 5 points on this on S&P futures. I say that because essentially, if you're going to be profitable in a trade, it has to mean that somewhere in there, uh, the the market has mispriced. And if this index, like right now, we're just speaking of S&P futures, and if the average swing is like 24 points, and you're looking to get maybe 3 to 5 tops, or 6 maybe tops, then you're trying to capture, anywhere from an eighth to maybe a fourth of the entire daily swing. That's already a good bit. Yeah, you'll see guys who talk about knocking it out of the park with these huge swings, but the chances of you catching a level that's that much mispriced are highly unlikely in a market that's efficient. Of course, conversely, if you see that we're breaking out well above that half deviation early in the day, then that can also be foreshadow of the market continuing to move down on the day, is illustrated right there. That's all I had to say on this tip. See you guys on the next tip. Okay, one last thing, guys. Please remember to add 4 points to the quotes. I'll usually mention it inside of the chart markup, but since these are coming from CFD, contracts for difference, I usually will mention to add 4 points to the quotes on the Twitter feed. Okay, I hope that helps some guys get a lot more utility out of these chart markups that I'm sharing here on Twitter. Thanks again, guys, for taking the time to check this video out. See you guys on the next video. Once again, this is Alfred from BinaryOptionsTutor.com.